Most retail traders open their charts and immediately look for market tops and bottoms. They draw their supply and demand zones around major reversals, attempting to catch the exact moment a trend dies. By focusing on these endpoints, they overlook the momentum happening in the middle of the chart. Instead of joining a strong move, they step in front of it, acting as liquidity for large institutions that are pushing the market further along its existing path. You don't need to predict a reversal to be profitable. Entering during a proven, ongoing trend offers a clear structure for high-probability setups. To find these continuation setups, we look for two specific footprints: the rally-base rally on the long side and the drop-base drop on the short side. These patterns occur because major financial institutions cannot execute massive positions all at once. If they attempt to fill a billion-dollar order during a fast move, they risk slipping the place and degrading their own entry. Instead, they pause. They allow the market to consolidate in a tight range, the base, to accumulate their positions. When they initiate the next push, they leave behind a zone containing their resting, unexecuted limit orders. The objective of this blueprint is to wait for the price to return to these consolidation zones and ride the next institutional wave. Step 1 is identifying true institutional momentum. We need to distinguish between slow retail movement and aggressive displacement that aligns with the higher timeframe trend. We filter this using the 70-30 rule. Look at the initial rally leg. The solid body of the candlestick must make up at least 70% of its total height, with wicks at 30% or less. Seeing 2 or more consecutive candles meet this ratio identifies a sustained commitment of capital that small retail volume cannot produce. If the move lacks this 70-30 profile, the momentum is insufficient. You are looking at market noise, and the setup should be ignored. Step 2 identifies the pause immediately following that explosive move. The market must temporarily digest the momentum before it can continue. We filter this using the 25-75 rule. You need a cluster of 2 to 3 consolidation candles, where the bodies account for 25% or less of the total size, while the wicks make up the remaining 75%. This body-to-wick ratio indicates that buying and selling pressure have reached a temporary equilibrium. This tight range is the footprint of smart money accumulating the remainder of their positions without moving the price against themselves. Once the pattern is identified, draw the boundaries of your actionable demand zone. Anchor your rectangle tool at the lowest wick of the base candles. Pull the top line to the highest point before the breakout, and extend this box to the right. If the candle that breaks out of this base leaves behind a fair value gap, it adds a layer of confirmation to the setup. Drawing this box creates a predefined trap for the market to fall back into, giving you a mechanical area to watch for entries. Step 4. Execution. Retail traders often fail by aggressively chasing the breakout, only to watch the market slam back like an iron gate. Large players often pull the price back down to trigger the stop losses of those breakout buyers before the real move continues. The institutional protocol lets the breakout happen, patiently waiting for a retrace into the demand zone. Wait for price to tap the 50% mark of the box. When it touches this level and prints a bullish confirmation candle, trigger your entry. Place your stop loss just below the bottom of the base zone with a small buffer, and target a minimum 1 to 2 risk-to-reward ratio. Entering on the retest rather than the breakout aligns your trade with the resting orders that actually drive trend continuation. You now have a mechanical system to identify and execute trades based on institutional footprints. This approach helps you avoid breakout traps, secure entries at discounted levels, and define your risk before you ever enter a trade. Using a mechanical checklist removes the subjective guesswork and emotional reactions that often lead to poor trading decisions. To automate this chart hunting process, check out the Quantum Smart Money AI indicator in the description, and be sure to subscribe for more technical trading strategies.